Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thank you everybody for joining our Multifamily 0 to 1 episode 21 with Jorge. And for those who are new here, for this meetup, we focus on getting started as a multifamily syndicator.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
So let's just go through some introductions for those who haven't met me. My name is Marcelo Cazini. I'm a co-host of the Multifamily 0 to 1. And my background is in IT and software development with an MBA from Texas A&M. And I'm a local Houston CCIM member. I completed all the CCIM designation trainings, which is the commercial investor member designation. I'm a multifamily investor. I own and operate my own commercial real estate. And prior to multifamily, I also was involved with single family fix and flips.
Hi everybody, this is Claudia Rubio. I was born in Colombia, South America, and we've been living here in Houston, in the States for 7 years already. I have an architecture degree, and mostly my asset management background comes from Colombia, managing my own assets from my family and then our assets when we met. And I also hold a National Apartment Association certification. And yeah, I'm gonna hand it over to Martin.
Thank you. So I'm Martin Rubio. I'm an IT security consultant. I've been doing that for over 25 years. Most of them, I had my own consulting firm. So I managed that business for a long time in Colombia. We've had with Claudia several businesses related to real estate, several properties, hard money lending firm. So between her asset management experience and my business management experience, we make a good team on multifamily, and we decided to syndicate a couple years ago. We have syndicated one deal here in Houston, and hopefully many more. That's it.
All right, thanks Martin, thanks Claudia. So we're excited to bring Jorge to be our guest to our meetup. So Jorge, do you wanna go ahead and introduce yourself?
Yeah, so I'm Jorge Abreu, the CEO of Elevate Commercial Investment Group. I started in single family investments about 14 years ago now. Opened a construction company a few years into it to scale the fix and flips. And then about 4 years ago, started going more into multifamily to the point where that's all I'm focused on now. Large syndications. End of this month should be over 2,000 doors and continuing to build.
Excellent, thanks.
All right, let's get started, Jorge. So we want to ask you, how did you start in real estate? So, and I guess multifamily was not your first avenue in real estate. Why don't you tell us a little bit about it?
Yeah, so I started in single family, and I guess how I got started. I was starting to be an engineer, and I knew at some point I realized I didn't want to be an engineer. So I started looking at different paths, and some point decided that I wanted to do real estate investing. So I thought I needed a broker's license. I got my realtor's license. I got my mortgage broker's license. Did some of that for a couple of years, but the plan was always to do investing. Finally, I got a coach and started doing some wholesaling, then some fix and flips. Quit my W-2 at that time, which I was an engineer. And then I got burned a couple times by contractors as I tried to scale the fix and flips. And that's what really pushed me to open my construction company. Then I scaled the fix and flips. We're doing maybe up to about 50 a year for a few years there. And it was a lot of work, to say the least. And I knew there had to be a better way. And that's when I discovered multifamily syndications. Before that, I didn't know how these apartments were bought. I just thought it was somebody that had a ton of money and came in and bought the apartments. So once I found out how the syndications work, started digging into that, got a coach on that end, and then that was maybe about 3.5 years ago. And I love it. I found my passion in multifamily, so I put all my focus towards multifamily investing, and then the same with my construction company.
Awesome. So I think for a lot of people who come into the multifamily space, they usually have some kind of a similar path. They had their W-2. They some of them started with single family. Some of them did just long time rentals or fix and flips. But at some point when they heard about multifamily, they, as you mentioned, they decided to get educated, right? They needed to understand how that business worked. Some of them just went with a mentor. And I think for people who's here trying to get some experience from you, what did you try and what would you recommend to get that initial education? Is it, in your perspective, is it better or do you have any recommendations on books, podcasts, or mentorships, or anything like that to get acquainted to everything you need to know to get started in multifamily?
Yes, there's a lot there. Let me try to break it all down. So, I went the route of getting a coach. I guess that's the most expensive route in a sense, at least with the upfront cash. Do I think you can learn the business without getting a coach? Yes. Do I think it's gonna take longer? Yes. You're probably gonna have more failure along the path as well, along your journey. But with that said, if I was to do it again, I think I would probably try to find one part of multifamily where I feel like I can add the most value, and then find someone that's doing it at a high level and bring that value to them and kind of learn that way versus a coach. For example, maybe my construction company and my experience on that end, I could have easily have brought that to somebody else that was acquiring a lot of multifamily and possibly learn the business that way. But on top of that, I mean, you've got a ton of good podcasts. You mentioned books. I think for somebody really just getting started, Joe Fairless's book is great. He breaks it down every sector of it pretty much and does a good job of it. Podcast wise, I mean, there are so many now.
Yeah.
I don't know what to tell you there. I mean, just start listening to them. A ton of free content out there.
Yeah, I would say just choose a couple that you like and stick with those because there's so much content out there. Yeah, you're right. Okay, so when you felt you had enough education to go hunt that first deal, what was your criteria? What was that specific type of property, location? What were you looking for that first deal?
Kind of your C-class property, value add. As far as returns back then, I think I was honestly, the numbers I was told to hit at that time were not realistic. And I don't know if it was and that took a little while to kind of realize that, you know, my coach was telling me to hit these certain returns, but with where the market was, it was pretty much impossible. And I don't know why. Thinking back, I think he was just trying to, I guess, watch his back, you know, and make sure. I think he had possibly gotten sued before or something. But anyways, the point is, it was the C-class value add. I underwrote probably over 100 plus deals, starting here in DFW. I don't think I mentioned that, but I'm out of Dallas. And nothing was penciling. And not till I started going outside of the market and getting comfortable doing that, I was able to get some deals to pencil in and acquire my first property.
Okay. So you were not restricted on a specific location, like it doesn't have to be here in Dallas close to you or like 2 hours from you, or you were, as long as you were comfortable with the market, you were open to any market?
It took a little bit to get there. I mean, at first I definitely wanted to do it in my backyard. And it you know, to a certain point, Dallas was one of the hottest markets and
yeah,
kept getting in these highest and best, and just, I didn't feel comfortable paying some of the prices, especially with my construction background. It didn't make sense when I was getting so close to what I can build these properties for. And I'm talking about C class in a C minus area. So it took me a little bit to get comfortable and kind of figure out the systems of, okay, so how do I get familiar with a market that I don't live in, you know, that I don't know. So that was a whole other learning curve and almost mindset kind of shift.
Mm-hmm.
okay. You said you underwrote probably 100 plus deals. How long did it take since you said, okay, I'm gonna go look for that first one until you got it? Like how many months, or just as a reference?
I know it was over a year, but that's including
Okay.
getting educated and whatnot. You know, by the time I really had the underwriting down and some more systems in place, maybe about 6 months.
Mm-hmm.
Okay.
So we do have a question. Rajesh has raised his hand here. So Rajesh, do you want to go ahead and ask your question? Remember, you're muted, so unmute yourself first.
Yes, hi, this is Rajesh. Thanks, sir. There's a follow-up on the question which Martin just asked, like what were you looking in your first deal? And you referred to something like we are looking at certain target returns, but maybe I didn't catch up. So just wanted something. What were the target returns where you were looking for in your first deal? And more on that thing, what is a realistic or more common type of returns which we can potentially expect in, say, deals in the current market?
Yeah, so the first question, from day one, if I remember correctly, like the cash on cash had to be an 8%, and then I can't remember the total return, or it was more the cash on cash from day one was the tough part, especially with it being a value add deal. So that was really the part where I realized, okay, well, you know, maybe if I'm not coming in at this cash on cash, but I know I can increase it, that's when it started kind of clicking, if that makes sense.
And the second question is, what are you seeing in the market right now, George, in terms of current returns?
You know, it seems like IRR is mid-teens is what a lot of folks are kind of putting out there, what the market is. I personally like deals that are a little higher than that. And it's just, there's got to be that true value add in there to get it there. But at the same time, it's become more difficult to do those deals because of financing. So we're looking for a very specific type of deal where the cash on cash is there from day one. Your occupancy is doing decent, but there's still more of an operation type value add to it.
Good. So, Rajesh, I don't know if that answers the question you had. I have also seen a lot of deals in the maybe 7 to 8% yearly cash on cash with maybe a total return 70 to 80% over 5 years. Those were numbers more common pre-COVID. I think we're all kind of watching. There's some of the deals now post-COVID, but that seems to be the number that I was seeing until very recently.
Yeah, thanks. So yeah, that's pre-COVID numbers are like typically 8% cash on cash with a total of about 80% in 5 years. I was just trying to get a gauge of, we're still in the COVID, but with whatever is happening in the market, are those numbers, have they changed significantly, or we are still looking around the same returns with whatever deals might be coming up in the, say, in the near future?
Go ahead, Martin.
Sorry. Yeah, we're underwriting to with the same goals, around 80% total return cash on cash in 5 years, total return in 5 years, and then cash on cash try to stay around 9% if possible. But to be able to get 9% or more on cash, you have to have a specific characteristics on every specific deal, as George mentioned, related to how much value add you're gonna do, and then what other income you're able to find. So, but yeah, as a standard, 8% and 80% should be like the minimum that you should see right now. It hasn't changed too much from before COVID. Yeah, I think that the pricing has not changed much. It's maybe going a little bit up, but the interests are lower, so it kind of evens out. Yeah.
Yeah, I've seen some deals coming out a little bit lower than that, like 70% and like 15, or I think I even saw one that said 14 something as far as the IRR. I personally like to find the deals at minimum 16% IRR and closer to that 100%. They're not easy, and there's still some out there.
Yeah, for sure. Philip, do you have a question?
Okay.
What was that?
We can't hear you, Philip. Are you muted?
How about that?
Yes, we can hear you now.
Hey, great. Hi, guys. Yeah, thanks for hosting this. I used to go to 3 to 4 meetups a week. That all came to an abrupt halt, and underwriting, last year I underwrote over 12,000 units. And now I'm just starting to build up the courage now that we have a better sense of financing and investors and the market. So it's like, I see you've been closing on a lot of deals. I've been following you on LinkedIn, and so good job with that. But when we look to do a value add, what are you doing for your confidence to know the value add that you're proposing is actually something that you think you can accomplish? Because that's kind of where I'm having issues. That I'm an architect, and doing a value add isn't scary, but in this market, it definitely has shaken my confidence. So what are you doing? You're doing something right.
Yeah. So are we talking about pre-COVID or right now in this?
Right now, I'm whatever. That was a different world back then.
Okay. We're being a whole lot more conservative right now. You know, we're not going to do, I mean, before either, you know, we weren't going to be the first to do anything. I mean, it was proven, our business plan was proven somewhere in that market already. And now, you know, even if it's proven, we're still a little hesitant to reach for some of those rent bumps. So I think it's you got to be really cautious on the market and how that's doing, how collections are doing. You got to dig in big time because people are holding in their bad debt. So yeah, definitely being extra conservative.
So George, do you want to give us some examples of, as a follow-up to that question, what are some of the renovations that, especially for the folks who are maybe starting to underwrite, what are some of renovations that you typically do on a value add, and what have you seen in terms of cost per unit to do those renovations, and have you seen the cost increase or decrease over the last 6 months?
So as far as the cost to get the renovations done, has not increased. Some materials, maybe some lead time on them. Appliances has been one of them. The cost really is in the building materials. So if you're, I mean, there's a ton of developers right now that have put their projects on hold. The cost of lumber and concrete's absurd. And then we've really changed our model. Like we're not doing the heavy lifts we were doing right now. So we're doing pretty light on the upgrades, not spending no more than 5,000 for sure per unit. And then if the market's telling us we can get a rent bump of maybe 200, we're factoring in half of that.
And what do you typically are accomplishing a $5,000 rehab as of right now?
So you can figure in, you know, paint everything, paint your cabinets, your walls, ceilings, everything. Then probably resurface your countertops and your tubs. Where it gets tricky is when you start talking about flooring and appliances. That can add up pretty quick. So you can kind of interchange some of that stuff. You know, if you want to replace all the fixtures, all the plumbing and lighting fixtures, you can probably do all of that, but not the flooring and the appliances.
So you feel like you have to, for the 5,000, you have to either pick light fixtures or flooring and appliances.
Pretty much. Or some, you got to mix and match there.
Okay, that's good. So what is so for somebody that's starting now to looking to syndicate their first deal, especially post-COVID, what would be your best advice for somebody starting now?
For somebody starting now, it's not an easy time to start, but not trying to discourage anybody. You know, you got to be ready to look at a lot of deals. There has not, if anything, there's been an increase on pricing. I have not seen any decrease. You know, we're going back to going straight to the seller, which is the way we started. So when we got into this, we kind of brought some of the things we were doing from single family into multifamily, and our first two deals we found straight to the seller, to the owner. kind of going back to that because I feel like that's how we're going to get these better prices. So I guess my advice is you have to look at a lot of deals, try to find the sellers if you can, straight to them, and make sure you're conservative when you're underwriting these things. Still a lot of unknowns. Still with COVID, I guess, there's still some unknowns there. Obviously, we got the elections coming up. Very market specific. Know the market that you're investing in.
All right, so know the market, go straight to the seller, and maybe be conservative on underwriting. When you're going straight to the seller, are you finding that it works better within a certain number of units, like maybe under 50? Or are you finding that any number of units, or the higher the number of units, the more educated they are, they're going to tend to go to the brokers? Is there a certain unit size that you're having more success?
I mean, I definitely think you would have more success under 100 units, but I also don't look at anything under 100 units. So for my specific situation, that 100 to 200 unit, once you start going above 200 units, is when they probably own several apartments, and you could start running into your bigger firms as well, which I wouldn't shy away from that either. I mean, I'm in talks with some of the bigger firms now too, to try to get some of the properties that they're selling before it goes to a broker as well.
And Bernadette was asking about your direct to seller strategy. So what are some of the things that you have done to find the sellers, and how to market yourself to them?
Yeah, we export the data from CoStar. We get real specific on what type of property we're looking for, obviously in what area. We export that data, then we cold call, we run skip trace if we need to. And then we've done mail outs, but I think I'm just gonna stick with the calling. Calling's worked the best.
All right, Philip, you had a question?
Sure. The direct to seller is great. When you do speak with a broker and the seller, are you noticing any seller expectations being a little bit lower than they were, say, a year ago? Or are you still seeing the top of the market asking price? And what are you finding?
Top of the market asking price. I mean,
Yeah, same here.
Yeah, I don't see any give so far.
Yeah, I've seen a couple deals we've either put an offer in or we didn't put an offer in, but we talked to the broker after, and they went for higher than asking.
Right. It seems like the brokers are the ones really nudging the sellers, saying, "Hey, stick with that number." It's just almost like I don't know what it's going to take for the brokers to kind of get with the program of what's happening out there.
Well, the thing is, there's a lot of demand. They're getting the number of offers they want. So this is one of these was a secondary market here in not Houston, not Dallas, not San Antonio, not Austin, and they got 12 offers.
Wow.
Yeah, that's the issue is supply and demand right now.
Yeah.
You've got a lot of investors wanting to buy, a lot of money out there.
Yeah, that deal went 1.5 million over asking.
Over asking. 1.5 million over asking.
Wow.
Oh.
Yeah. There's a question. Leila is asking a question, George. Do you find that bigger, more institutionalized sellers are already maximizing their NOI versus the small sellers?
It depends. I mean, one of these larger firms that I was talking about that I've been discussing possibly buying some of their properties, they specifically leave a nice chunk of units to be upgraded, and they leave that meat on the bone. So not necessarily. I mean, if you're talking about mom and pop, you know, usually, yeah, those are going to have definitely a lot more upside. But then there's that middle, right? You know, there's the investor that has done 7 syndications or so, and I feel like they might be the ones that are really maxing it out, and not the ones above and the ones under.
Yeah. Charles was mentioning that we should define IRR in case someone's not familiar, because we were talking about cash on cash and total returns. If you're not familiar with IRR, it's basically the internal rate of return. It's a financial term mostly used on the financial world. I'm not really familiar with how it works. It's a mathematical formula, but it's basically the weight of money over time. So yeah, you can Google it. You'll find really complicated formulas, but if you understand, if you see, once you start seeing deals, you're gonna understand what ranges you want to be on and what's related to the total returns and cash on cash that you want to pursue. Yeah.
The more money you get back, the quicker, the higher your IRR.
Yeah.
Yep. Yeah, it really takes in consideration not only the amount of money you're getting, but the time of the money. So if you're getting the money quicker versus maybe you get the same return, but in 5 years, then your IRR is going to be lower. So it takes in consideration like Charles was saying, the compounding and the cash flows that you're getting, but also the important piece is timing. And
yeah, Leila just added IRR is the present value of your returns combined.
mm-hmm.
Yeah.
So Jorge,
go ahead.
You mentioned skip tracing. Can you please explain to the people that might not know what's skip tracing and what works best for you on that?
Yeah, so I mentioned CoStar is where we get most of our data from, and then it's not always 100% accurate. And if we have the name of the owner, we can there's a bunch of different sites out there where you can skip trace the owner, or there's VAs that'll do it as well, and pretty much they'll try and find the correct phone number for that person.
And which technique do you use best? Do you have like a vendor or?
A VA.
A virtual assistant. Okay.
All right, Philip, do you want to go ahead and ask a question?
Reonomy is a good resource for us. That's one of the ones we use virtually every time we underwrite a property. I mean, it's a couple $1,000, but it goes throughout the country, and you know, we couldn't afford the CoStar in you know, where we're at, but anyway, Reonomy seems to be doing the trick for us.
Have you found that the quality of the data, Philip, is pretty decent?
Actually, I found it reliable. Yes.
Good.
Yeah, for the most part, CoStar is too. And you can reach out to them and tell them, hey, this information is not correct, and they'll research it and get back to you. But yeah, I've heard good things about Reonomy.
Right.
I'm paying so much for CoStar already.
No, CoStar is what you that's the gold standard. That's kind of what you want. But the hard part for me, actually, a lesson I've learned was after you see that this guy bought the property a year ago for $2 million and now it's on the market for $4 million. It's like, what the heck did you do in the past year to warrant 100% increase? And me getting over that kind of appreciation is like, okay, if the numbers work, we'll look at it. But when you can actually look at their debt and who owns it, and that's what we found good about it.
So George, now with all the experience you have, if you look back, what would you have done different as a syndicator?
I would have started multifamily, straight to multifamily and not single family.
Mm.
You know, I don't want to say I didn't enjoy single family. I did. I like transforming properties in general. And we started towards the end. We started doing some really nice new construction, single family, but just the cash flow concept and the fact that you can build like a large amount of wealth versus I got very sick of from one transaction to the next on the single family, and I kind of got burned out trying to scale that company. And yeah, so starting with multifamily.
But on that, if you take the first deal that you've done as a syndicator, would you have done anything differently on that particular deal?
Absolutely.
What are some of the things you would have done differently?
Yeah, I would have bought more units. My first one was 37 units. It is probably, to this point, the one that I've spent the most time on, and not just because it was my first deal, just because the amount of units, you don't have the on-site staff to manage it. So I was very, very involved on the day-to-day.
So what's the minimum size you will look for now? 100?
100, I mean, and if it's maybe 80 or so and it's in a market that I'm already in, I'll look at it.
Okay. So when you look at a deal to buy, what are the deal killers? What are things on the property specifically that you will say, no, I'm gonna stay away from it?
There's not a lot, just because I know most of the things can be fixed. You know, things that kind of creep up on you, the sewer lines in these 1960, early 70 properties can really start to add up. So, you know, if I scope the lines during due diligence and I just feel like most of them are falling apart, I may walk away from it. Or if I've got enough if I'm getting it at a good enough basis, then, you know, I'll proceed. You know, no type of roofing really scares me. I'm good with all of them. Chillers and maybe chillers, not a huge fan. I'm okay with boilers. And that's really it. I mean, area more than anything. There's not much that scares me about the properties, but there are things in the area that can throw red flags. Crime, is that what you said? Yeah, not just any crime, you know, like the types of crime that are going on, and crime at a specific property doesn't scare me either. It's more of if it's happening all the way around, that's going to be a lot harder to fix than crime at the property.
Right.
So you mentioned, George, that you may walk away depending on what's the state of the sewer lines after due diligence. But if you consider that, I mean, a lot of deals right now requires hard money. Are there any things that you feel like you can do before you get to the due diligence in order to avoid having to walk away and then maybe having to forfeit hard money?
Yeah, I've never done hard money day one. I know for some of well, I guess DFW, if you want something and you're not straight to seller, I guess you kind of have to. I don't know. But yes, there's a lot you can do. I've got a full checklist of items that I look at during a property tour. I don't just walk around aimlessly during a property tour. I'm examining everything. I ask for a lot from the brokers. I get rejected a lot of the times since I don't have it under contract, but I stress to them that, look, if the more information you give me, the better my offer is going to be. The more I know about the property, the more I'm going to feel confident with my offer. And for the most part, they usually give me the information. The information I'm talking about is things like CapEx that's been completed, the age of the roofs, how many ACs, water heaters, what type of electrical wiring, has anything been done? Have they been pigtailed if they're aluminum? Just those kind of things.
Okay. I have a question which is very specific to your case, because I think every single syndication group has their own strengths and weaknesses. And I think, for example, having your own construction company, it's a huge plus at the time of acquisition, right? You already know a lot of the due diligence that you need to do, how much it's going to be, how long it's going to take. So that gives you an awesome advantage. But it also, I see it has a potential conflict of interest when you have acquired it and then you're asset managing. And I'll give you a couple examples. We've seen either from deals we've invested passively in or talking with other sponsors, we've seen deals in which the property management has specific vendors they prefer, even though they're not the best for that deal. Or we've seen one specific case of a property here in Houston where the regional manager of that property management company only hired someone related to her to do pretty much all the work. And those two deals, they had very bad returns because of that. How do you manage that potential conflict of interest?
I don't see how that's a conflict of interest. That's what we're doing is checking that. So we're not allowing that to happen, because anything major that goes on the properties, they have to run it by me pretty much, or by my team. And if it doesn't look right, I'm not going to overpay for something. I can easily get my own crews to come in and do some of the work. I personally don't like tying up my resources for maintenance type things, but if it's something large, yeah, we've done it at some of our properties where we didn't like the numbers the property manager was giving us, and we went ahead and got it done for a lot cheaper.
Okay. Do you have your own property management? You have third party, right?
Third party, and then so was this third party or was this in-house property management?
One of them, not both of them were third party. Yeah.
And talk about third party. There was a question here on the chat by Matt. He was asking, how do you align the third party property management with the objectives of the property? I mean, do you do anything specifically in terms of compensation, or do you to make sure that they're hitting the objectives, or how do you approach the third party property management alignment with the goals of the property?
Yeah, I mean, we have weekly meetings where we go over our KPIs and our budget. We make sure they're always aligned with our business plan and what we're trying to accomplish. We don't do any compensation as far as like if they're hitting a certain NOI or anything like that. In our eyes, it's the property management companies getting paid to manage that property correctly and to execute your business plan. What happens a lot of times is the asset manager isn't doing their job and they're not actually keeping track of the property manager. We never take our finger off of it. We call them out when they're spending too much money or something's not getting done like it's supposed to be, we're constantly, and we're not doing it like, we have a good relationship, but I mean, we're checking it and we're telling them, hey, look, you're not hitting this number this week, or this report you just sent is not accurate. This and this, and it works. I mean, we've had to fire property managers before for not hitting it and for not hitting their numbers, and it improves properties, that's for sure, when you get rid of a bad property manager.
For sure. So Jaspreet had a question. Do you want to go ahead and ask, Jaspreet? You're unmute yourself
Yep.
first.
Yep. Hey, George. So I wanted to find out, how many people do you have on your own staff, let's say, or in your asset management team that have the ability to go ahead and read these reports, understand the line items, figure out what may be off, why, who's keeping track of weekly emails, daily emails, and line items for maintenance across all these properties, and actually having communication with these property management teams, and then of course your GP team. So how many people does it take to be able to asset manage all these properties and keep track of every expense, to be able to actually double check your property manager's report and say, nope, this is wrong, that line item is not accurate, or whatever the case may be?
I mean, it takes one individual really, for each property. So we have different co-GPs and several different deals on my team. So on Elevate, there's two of us that are capable of it, and we've split that up between the ones that the deals that we are the assigned like asset manager, like this is what you're going to be doing. So, and then on some other ones, our co-GP is responsible for that, and then we're kind of just reviewing it, making sure that they're checking it. Does that answer your question?
Yeah, I was just trying to figure out, right? I mean, you have acquisitions, you have rehabs, you have disposition, you got financing, you got asset management, and you have all these different aspects that you're trying to manage in a deal as a GP or a co-GP. So I just wanted to get an understanding of, at your team level, let's say Elevate, and you're the CEO, you have, let's say you may have somebody in finance, you may have somebody in asset management, somebody in acquisition, somebody who's working with the VA to do the cold calling and following up on leads, and somebody's arranging financing and debt. So I was just trying to figure out, between all these activities that an individual may be doing, how much time are you allocating to asset management, and how many people per property, and how many hours per week are they dedicating to each property and asset management, so that they can actually keep track of all these expenses and all these reports and actually double check all that?
Yeah, hour wise, I mean, I don't know to the T how many hours, but we have specific reports that are due every week, and they all look similar. The property manager, we don't take the reports. They need to report the way we like it, and the KPIs that we like to see. So that makes it more uniform. And then we take those reports, then we dissect it. We always have our scheduled weekly meetings for each property, no matter what. And yeah, I mean, having a set system, tracking KPIs, and then having a weekly meeting goes a long way.
Cool. Yeah, I appreciate that. Thanks.
And there was a question on the chat here from Jean about, what are your thoughts on the eviction moratorium that's going on right now? And do you think that that's going to be the 800-pound gorilla that will make the prices go lower?
I mean, I think it's crazy. There's one. I don't know. I don't know. I guess I haven't been watching the news for the past week or so, but from what I take it is that nothing is going to happen until after the elections now is the last thing I heard. Which if that's the case, I mean, yeah, that's not, there's definitely going to be some opportunities coming up if that's the case. You know, if you're not letting individuals or owners evict tenants, and you're also not giving them relief for the ones that need it, yeah, there's going to be opportunities popping up and people losing properties.
So on the way you analyze deals, do you have any specific tools that you recommend? We know you use CoStar for collecting the data. Do you have any specific tools you would recommend for anyone to underwrite their own deals, or for any like estimating expenses, things like that?
I mean, we grab a lot of our data from CoStar, and then there's a lot of information you can also find from just searching, right? You know, population growth, you can usually just search for it and get a good idea. Same with household income, and you know, cap rate's probably going to be tough to find for a certain market without CoStar, but other tools, I think that's about it.
Okay. What about any horror stories that you would like to share for people just to try to stay away from anything like that? Do you have any?
Gosh, I'm trying to think of one. You know, a mistake we've made in the past is just make sure you check every single unit. We missed some down units on a property. It wasn't the end of the world, but definitely taught us a lesson. Don't take what the broker or seller tell you.
Mm-hmm.
Do your own research, no matter what it is. I say this all the time, and I think somebody just told me, it was this week, I don't know if it was yesterday or the day before, about the roofs. You know, we're talking about a property. I'm going to go look at it for them and bid out the work. And they were like, oh, don't worry about checking out the roofs. You know, the seller told me, or the broker told me it was replaced last year. Like, okay, I don't like, I'm still going to jump on the roof. So yeah, don't take anything they tell you.
Yeah.
It's not like I mean, sometimes they're not even trying to trick you or give you false information. You know, a roof can be replaced, and it can be replaced incorrectly, and be just as bad as not being replaced. So
Okay.
I'm just using that as an example. I mean, there's several.
Mm-hmm.
What happened with those units that you missed? Were they like just vacant, or were they like trashed out and you had to do some heavy lifting on those, or what happened?
They were down units. They were true down units.
Okay.
Water loss.
Not much.
Oh, wow.
Yeah,
Okay.
it's 2 units.
That's good to know.
All right.
George.
Well, go ahead, Philip. You have a
Okay.
question?
Yes. Well, this question is probably skewed with your background, but if you've got a 100-unit property, would you walk through every unit, or would you walk through every 4 or 6 and leave the actual inspection, the walkthrough, to the inspector that you're hiring, or what do you think?
So like me personally, walk every
Well,
100?
you or your team. I feel confident when I'm walking every single unit. And if I find that there's a trend, I'll probably just hire an inspector, say, look at, you know, these, 1 in 4, 1 in 5 units. But
Yeah, I mean,
that's just me.
We've gotten pretty systemized with it. I mean, you know, my team is the one walking it, all of them. I guess it's a little different because I bring my construction company, and my project managers and my site supervisors are the ones walking it. but we use software, and they all have to check the same thing in every unit. You got to take certain pictures. It doesn't let you go past it to the next step unless you do that. So I mean, it's kind of hard for them to miss something when you're doing it like that.
Mhm.
I personally still like walking some of the units myself, you know, to get a feel for the tenant base and just the condition of the properties.
Got it. Thanks.
Of the units.
All right, and Jaspreet, you have a question?
Sir, so I was going to ask you that, you know, you may have missed some units that had some or down units, and those were physically units that were in disrepair, needed a lot of heavy lifting. But how about a lot of times I've heard, you know, let's say sellers or property management companies may bring in a boatload of people or even 5 or 7 people into, let's say it's a 100-unit building, and they start filling up units over the last 3 months just to start putting bodies in units and getting documents to show you income, and then you know you finally buy the property 3 months later, all of a sudden you have 17 evictions to go through or something of that nature, or people just squat or whatever. And I've heard people hire teams or certain individuals or companies to go out and do some sort of forensic accounting or validation and lease verifications and all that stuff. Have you ever used them? And if not, why not? If you have, what do you think of that?
I think it's smart, and I think we're probably going to start doing it. It happened to us on property we acquired. The seller falsified information, and we actually ended up suing them for that because it was a significant amount. Yeah, that's not a bad idea.
Has anyone in this group used one at all, and know, is it worthwhile at, let's say, 50 units, 100 units, 200 units? You know, what scale is it worthwhile at, and what does it normally cost? What kind of companies are out there? Just putting it out there because I'm guessing that, you know, since a lot of us are newbies or have not done a deal yet, and we're looking at doing underwriting for these things, and even George, like you just mentioned, it happened to you, and you're somewhat what I would consider an experienced operator. So if it can happen to anyone, at what scale is it best to go ahead and implement that? What does it normally cost? And, you know, are there nationwide companies? Is it specific to certain areas?
I think from our experience, so we are from Colombia, right? So we we are very skeptical, and we want to check everything twice. We did hire a company to do a property management company to do the lease audit during due diligence, and they brought in construction companies or like different vendors specialized on piping and roofing and wood for the exteriors and HVAC and foundation. I don't know, 20, 25 different companies came in, and one of them, we asked them, we need you to walk every single unit, and between our team, we split up, and they split into 3 teams, and at least one person from our group was with each one of those teams. So at least one of the co-sponsors walked every single unit, and there was maybe 1 or 2 that they didn't open the door that day or something. But other than that, we didn't miss any units. And I think when you're preparing for that first deal and you're putting all those things together, your attorney is your insurance guy, your everything that you want to put together, you also have to start thinking proactively on that due diligence. What are you gonna need at that time, and be prepared for that. I would say typical cost for due diligence would be around $50 to $60 per unit, but it will depend. Your mileage may vary depending on your location. If the property management company you're using for that is going to be the same one you're going to be using for managing the property, or if you're just hiring one just for the audit. It depends on your relationship with those construction companies. I'm sure George can tell us maybe on his side, if he provides those services to other people buying properties, how much in average they charge. But that's our experience. I don't know, George, from your side, do you have anything else to add?
Yeah. I mean, I think the question was more a detailed forensic, like for instance, the issue we had is the leases were there. It was just the information was falsified. They were just sticking bodies. The units were full and the leases were there, but it was falsified. It wasn't, they were just sticking people in there. So they're not individuals that can actually afford it. So you're gonna end up having to evict them.
Mm-hmm.
As far as the other items you mentioned, yes, I think it's smart to hire somebody and do those things. We are offering it more and more now. And we're in that about 40 a door or so.
That's just the construction side, right? Not including the leasing audit.
Correct.
Yeah, okay.
Correct.
So I think on the previous question, then I didn't understand completely. So I don't think it's common to do that level of analysis, because in this market or in this space, we're dealing with unaudited financials. So your whatever you're getting as financials could be faked, could be maybe sometimes, as George mentioned, maybe sometimes without any intention, it's just wrong. And so unless you're buying something that's huge from a really organized company who hires like a big accounting firm just for the financials, you're not going to see any audited financials. You're always going to have that risk. And even if you hire someone to go audited, I don't think it's going to be an easy task.
Mm-hmm. All right, those are some great questions. So I did post our link to our YouTube channel on the chat, so hopefully you guys have a chance to subscribe to it, and so you can get notified in case you miss a meeting. It's also always available on the main multifamily021.com website. You can always subscribe through there. And with that, I want to make sure I remind everybody, especially the new folks, we always meet on the first and third Wednesday of every month. So the first Wednesday we focus on the syndication side for sponsors and co-sponsors, and the third Wednesday we focus on the passive investing side. So it's always a good opportunity to meet with passive investors, and especially to understand what's important for them, even if you're looking to syndicate. So our next one is October 21st. That's going to be our passive investor version. And then we're back on the first Wednesday, which is November 4th. With that, I want to say thanks to George to being our guest. And I have his email address there. So if anybody have any questions, George, hopefully it's okay for them to reach out to you.
Absolutely.
So yeah, so this was great content, and we appreciate the time, George. So guys, please take a screenshot there of his email address, or you can check on our YouTube after. But if you have any questions, if you need any information from a construction perspective, feel free to reach out to him.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.